In today's lecture, we are going to discuss the different financial markets and the different methods of issuing securities. The security market is the place or medium where buying and selling of the securities takes place. Market mechanisms make possible to transfer funds from the surplus to deficit sectors efficiently and at low cost. Most of the countries in the world have developed such markets to facilitate the securities trading, and it's considered to play a significant role in the economy. We can classify the security markets into two main types: the primary markets and the secondary markets. Another classification could be money markets and the capital markets. This figure shows the main classification and the sub-classification of the security markets. As we can classify the security market into three main types: the equity market, debt market, and derivatives market. The equity market can be classified into the primary market and the secondary market, whereas the debt market can be classified into government securities market, the corporate debt market, and the money market. And finally, we can classify the derivatives into options market and the future market. When the firm need to raise capital, they may choose to sell securities. These new issues of the stocks, bonds, or other securities typically are marketed to the public by investment banks in what is called the primary market. The primary market is the market for new issues of securities, bonds, preferred stocks, or the common stocks. The investment banker is the stepstone of the primary market. Investment bankers advise the firm regarding the term of the selling the securities. The first registration statement must be filed by the Securities and Exchange Commission, describing the issue and the prospects of the company. When the statement is in the final form and approved by the Securities and Exchange Commission, is called the prospectus. At this point, the price at which the security will be offered to the public is announced. There are three different underwriting alternatives for the company. The first is the typical underwriting arrangement, in which the investment bankers purchase the securities from the issuing company and then resell them to the public. The second is the best effort agreement. In this case, the investment banker doesn't actually purchase the securities but agree to help the firm to sell the issues to the public. And the third is the private placement rather than the public offering. In this case, the firms using the investment banks sell shares directly to the small group of institutional or wealthy investors. Because the private placement are not made available to the general public, they generally will be less suited for the very large offerings. Moreover, private placement don't trade in the secondary market like the stock exchange. This greatly reduces their liquidity and they reduce their price as well. So how the initial public offerings happen? The investment bankers manage the issuing of the new securities to the public. Once the Securities Exchange Commission has committed to the registration statement, the investment bankers organize a roadshow in which they travel around the country to publicize the offerings. These roadshows serve two purposes. The first is to generate interest among the potential investors and provide information about the offering. Second, they provide information to the issuing firm and its underwriters about the price at which they will be able to market that securities.